Today we are going to talk about quality control. So first of all, we need to know the definitions of quality control. So quality control is a system that relates to the concept of professional competence and the meeting of professional standards in providing professional services so that the audit failure and audit risk are reduced to an acceptable low level. Why we should provide quality audit service? So, number one is to ensure professional standards are being complied, and also to restore and enhance public's confidence.
There are two components of quality control. First is ISQC1, which is International Standard on Quality Control, and number two is AI220, which is Quality Control for Audit Work.
There are 6 elements of quality control. The first one is leadership responsibility for quality. Under the firm level, it emphasizes on top level management where they should support and reinforce the importance of quality control. They should recognize and reward the high quality work and not only focus on the commercial driven. So under engagement level, it is designed to engagement partner to every engagement to take overall quality of the audit assigned. The partner should become a role model for other team members and should always promote internal culture that stress the importance of audit quality. The second element of quality control is ethical requirement, in which must have independence checklist. Under the firm level, it is to ensure fundamental principles of ethics are complied with. For example, to address independent issues, firms should put in place policies and procedures to identify and evaluate threats to independence and take necessary actions. Meanwhile, under the engagement level, on top other fundamental principles, compliance with independence requirement is primarily important. The engagement partner should be able to evaluate the client's background and financial statement, whether there is any threats of independence to the engagement team, and to eliminate it. This is to ensure the team is able to establish professional ethics during the course of the audit works. Any threat should always discuss with the partner. The third element of quality control is the acceptance and continuance of clients and engagement. Under the firm level, it is important to ensure the client has integrity, firm is competent to perform the engagement, and able to comply with ethical requirements such as independence. So under the engagement level, preliminary plan activities at the beginning of the work includes procedures acceptance and continuance of client. Accepting new client is more critical than continuing services to the existing, as the auditor has possesses knowledge about the entity and the environment. For a new client, auditor should investigate the prospective client.
The next element is human resources. Under firm level, it covers the policies and procedures that relate to recruitment process, development of competence, career development, performance evaluation, and compensation to the staff. For engagement level, the procedures developed must ensure that the partner select the audit team that has necessary competencies to perform the audit in accordance with professional standards and applicable regulatory requirements. The next element is engagement performance. For the firm level, it is to ensure every engagement team assigned has capability to deliver a good job. Each engagement team comprises engagement partner, senior, experienced, and less experienced staff. For engagement level, the engagement partner is ultimately responsible for the performance of the team up to the standard. The partner needs to assess the planning and risk, need to timely supervise the team, review process, and ensure the engagement team well documented their job before the audit report issued. For the last element is monitoring. Under firm level, it is to ensure the system of quality control remains relevant, adequate, and the policies have been complied with in the practice. The procedure should address the ongoing evaluation and may identify for necessary changes and periodic inspection on the selected engagement. For the engagement level, the engagement team, partner and member should communicate with the firm for any complaints regarding the quality control policies and procedures for better improvement and also failures to comply with professional standards for maybe disciplinary action to be taken.
So now we look into audit risk. So what is audit risk? Audit risk is risk that an auditor may issue an unqualified report due to the auditor failure to detect material misstatement either due to error or fraud. Then we look into materiality. So materiality is a threshold above which missing or incorrect information in financial statements in which considered to have an impact on the decision making of the users. There are three types of audit risk, and the first one is inherent risk. Inherent risk is a risk of a material misstatement in the financial statements arising due to error or omission as a result of factors other than failure of control. And the next one, we look at control risk. Control risk is a risk of material misstatement in the financial statements arising due to absence or failure in the operation of relevant controls of the activity. And then, the third type of audit risk is detection risk. It is a risk that the auditor fails to detect a material misstatement in the financial statements, in which it can be reduced by auditors by increasing the number of samples transactions for detailed testing. So now we look at the relationship between materiality and audit risk. When planning the audit, the auditor considers what will make the financial statements materially misstated. The auditor's assessment of materiality related to specific account balances and causes of transaction helps the auditor decide such questions as what items to examine and whether to use sampling or analytical procedures. This enables the auditor to select audit procedures that, in combination, can be expected to reduce audit risk to an acceptably low level. There is an inverse relationship between maturity and the level of audit risk. The higher the materiality level, the lower the audit risk, and vice versa. The auditor takes the inverse relationship between materiality and audit risk into account when determining the nature, timing, and extent of audit procedures. For example, if after planning for specific audit procedures, the auditor determines that the acceptable maturity level is lower, then audit risk is increased. The auditor would compensate for this by either reducing the assessed level of control risk where it is possible and supporting the reduced level by carrying out extended or additional tests of control, and reducing detection risk by modifying the nature, timing, and extent of planned substantive procedures.
The quantitative base for material is a percentage, which is typically 3 to 5% of total asset. Second one is total revenue. Next is income before tax, gross profit, and a 3 years average of income before taxes.
There are two factors influencing determination of materiality. So the first one, whether the law, regulations, or the applicable financial reporting framework affect users' expectations regarding the measurement or disclosure of certain items. For example, related party transactions and the remuneration of management and those charged with governance. And next one, we look into the key disclosure. The key disclosures in relation to the industry in which the entity operates. For example, research and development costs for a pharmaceutical company. And lastly, it is focused on a particular aspect of the entity's business that is separately disclosed in the financial statements. For example, a newly acquired business. Application of audit risk model to audit book. Audit risk model are as shown below. Audit risk equal to inherent risk times control risk times detection risk. Or we can simplify it as audit risk AR equal to IR times CR times DR. Audit risk model is used in deciding how much evidence to accumulate. So, PDR is plan detection risk. So the formula is PDR is equal to audit risk divided by inherent risk times control risk. This can be further explained by this example. Plan detection risk for inventory. It consists of inherent risk of 100%, control risk of 100%, and audit risk of 5%. So, as we can see, 5% divided by 100% times 100% is equal to 5%. So, in this example, it states that only 5% of material misstatements are exist in the inventory.
Consideration of analytical review procedure. Analytical procedure means evaluations of financial information made by a study of plausible relationship among both financials and non-financial data. Analytical procedure also encompass the investigations of identify fluctuations and relationships that are inconsistent with other relevant information or divide from predicted amount. It may be helpful in identifying the existence of unusual transaction or event and amount, ratio, and trends that might indicate matters that have financial statement and audit implication. Purposes of analytical procedure. To assist the auditor in planning the nature, timing, and extent of other audit procedures.
Second is as substantive procedures when their use can be more effective or efficient than tests of details in reducing detection risk for specific financial statement assertion. Third is as an overall review of the financial statement in the final review stage of the audit. And lastly, it is also commonly used to gather substantive evidence for detecting misstatements and of the audit.
Audit sampling. The definitions by ISA 530. Sampling involves the applications of audit procedure to less than 100% of items within an account balance or class of transactions such that all sampling units have an equal chance of selection. Express opinion in auditor report. An audit includes examining on a tax basis refers to the audit work carried on sampling basis.
For the sampling risk, the auditor's conclusion based on the sample may be different from conclusion that would be reached if a 100% examination were carried out. For example, auditor testing on control procedures for payment cycle. Suppose auditors know client has 1,000 payment voucher during the year and 50 of those payment vouchers are not properly approved, which is 5%. Therefore, if 20 representative samples selected should contain 19 samples correctly approved and 1 not properly approved, but Sometimes from 20 samples, maybe contain 5 samples were not properly approved, which is 25% considered material, or maybe all the samples are properly approved, which is considered immaterial at all. Auditor can lower the sampling risk by increasing the sampling size. There are two types of sampling risk in different types of tests conducted by the auditor. First one is in the compliance test or test on control. Under this, risk of assessing control risk too high equals to risk higher than it actually is. And then risk of assessing control risk too low, risk lower than it actually is. The second type of sampling risk is in the substantive test, where risk that the auditor will conclude that there is a material error when in fact it does not exist, and risk that the auditor will conclude that a material error does not exist, in fact it does exist. For the non-sampling risk refers to the factors that cause auditors to reach a conclusion other than the sampling size. For example, auditors rely on other representation on erroneous information. Non-sampling risk can never be a mathematical measure. There are two types of audit sampling. First is statistical sampling. Any approach to sampling that has the following characteristic. Number 1, random selection of a sample. Number 2, use of probability theory to evaluate sample results, including measurement of sampling risk. Number 3, statistical sampling permits the auditor to rely on a smaller sample for an intensive checking and making representative to a large population. And lastly, defend measure at the court as it is systematic approach of selecting sample. There are three categories of statistical sampling. Number 1, M, monetary unit sampling. It uses attribute sampling theory and techniques to estimate the amount of misstatement for a class of transaction or an account balance. A, attribute sampling, used to estimate the proportion of a population that possess a specific characteristic. And lastly, C, classical variable sampling. It uses normal distribution theory to evaluate the characteristic of a population based on sample data of which data should have equal chance of selection. For the second type of audit sampling is non-statistical sampling. Any other approach that has not the statistical sampling's characteristic. The auditor uses his professional judgment to select a sample and evaluate sample when conducting audit tests. Auditor may use non-random selection methods and require more subjectivity in making sampling decision and select those samples items that he believes able to provide useful information. The application of sampling on audit tests. First is planning the sample. Number 1, determining the objective of the test. Number 2, defining what errors or deviations are being sought. Number 3, identifying the population and sampling unit. Number 4, stratification of population. And lastly, deciding the sample size. There are two factors that influence the sample size. First is test of control, and the second is substantive procedures. The second application is selecting the sample. The sample that should be selected is the sample that can be expected to represent the population. All items should have equal chance of selection. The principal method of selecting samples are: number 1, random sampling. This is generally considered as the best method of obtaining a sample. Number 2, systematic selection. The auditors have determined a sampling interval by dividing the physical population by the sample size. Number 3, haphazard sample. Selection of a sample without a specific reason, without bias or structured techniques. Auditor must take care to avoid bias. 3. The third application is testing the sample or perform the audit procedures. The auditor should perform audit procedure appropriate to the particular audit objective on each item selected. And lastly, evaluating the results. First, each error discovered will need to be examined for its implication. Number 2, analyze nature and cause of error. Number 3, projecting the error. And lastly, draw final conclusion.
Many thanks for watching.
Girl, you know I want your love. Your love was handmade for somebody like me.